Hi, Zack. February 1st, 2025. Kicking off February here with a summary of what we've seen in markets this week. A exciting week again with lots of implications in our Canadian economy based on what the US is doing, but more importantly, policy here at home from the Bank of Canada goes in the opposite direction of the central bank in the US. Our Bank of Canada met this week and they cut interest rates again, a further 25 basis points. But the bigger takeaway from the meeting was the Bank of Canada here now has officially adopted, in my words, modern monetary theory, MMT for short. They have ended their quantitative tightening program, aka QT, and they are now going back to basically the COVID, the pandemic era of basically buying the federal government's problems. The federal government is going to continue to run deficits like we've seen over the last 5 to 6 years, and they can do that with the assistance of the Bank of Canada buying the bonds that the federal government issues. The federal government issues the bond, they raise the debt, the Bank of Canada comes in to assist when there's not enough real market participants for that debt. Outside of select Canadian pension funds, select sovereign nations, our Canadian debt is not as appealing on the sovereign debt markets globally right now, especially when you have the US situation going in the opposite direction of where Canada is. What does that mean in layman's terms? It means that we have a Bank of Canada that now says they are going to devalue the currency, the Canadian loonie, at an accelerated pace, particularly as it relates to the US, where the US is on much stronger fiscal footing. Plus, they are the world reserve currency. Second big item this week, here today, February 1st, we have tariffs being enacted by the President of the US on Canada and Mexico. That is going to make the cost of goods more expensive. Added with a weaker currency, it's also going to make it more challenging for home builders to source materials, and materials they do source it's going to be more expensive. We have a massive rebuild coming down in California because of the wildfires, the hurricanes from last fall in Florida. That's putting an increased demand and already shortages of critical materials, electrical components, mechanical, HVAC components. You're going to put in some issues here now with lumber and the tariffs. I see Canadian housing continue to increase in 2025, especially in certain segments of the market. Single-family homes, particularly where I live down in Newfoundland and the east coast of Canada, where we have a lot more demand than supply being added to the market. So we have, to summarize, we have a Bank of Canada that basically says we are going to devalue the currency as an aid to keep the federal government spending money in the backdrop of this tariff currency war, or have you be, with the US. Is going to make purchasing power of Canadians more challenged, and anything that's a real asset that can't be replicated basically with strokes and digits on a keyboard, which is fiat money. Gold is $4,000 Canadian an ounce. Bitcoin over 140,000 Canadian per Bitcoin right now. And real estate, hard assets will continue to appreciate in fiat money terms because of just those elements of I just talked about, and the continued devaluation of the currency. So going forward in 2025, I would expect to see real estate continue to at least hold its purchasing power, if not outperform, in the backdrop of a potential Canadian loonie going to 65 cents here in 2025.